Hi, this is Daniela Camboni, and welcome back to StansberryResearch.com. My guest today says we need to be preparing for a 60% or even a 70% correction in U.S. equities, but he has a detailed plan of how you can protect your hard-earned money. Please welcome back to the show, Dan Ferris. He's the editor of Extreme Value here at Stansberry Research. His strategy of finding safe, cheap, and profitable stocks has earned him a loyal following, as well as one of the most impressive track records in the industry. Dan, it's always good to see you. Welcome back to the show here.
Thank you, Danielle. It's good to be here.
Now, just so the folks at home know, you and I recently wrapped filming of a campaign you've put together, which outlines a detailed plan for a massive correction in the stock market that you're anticipating. So I'd love to share a little bit of the insights with our audience here today, Dan. Let's start with this forecast that you have that's quite dire here. A 60 or 70% correction. What would lead to that?
Well, it's simply the fact that the stock market is more overvalued. It's more expensive than it's ever been in history, including the 1929 and 2000 dot-com peaks. So therefore, one would expect that that at some point there's going to be a bear market, and probably a pretty nasty one, because we are in a huge equity bubble by any rational historical standard. And that is always followed by a pretty serious bear market.
And so has that cycle already begun for you?
You know, the funny thing about bear markets is you honestly, if you're really being honest with yourself, you don't know when you're in one. That's part of the problem. We could be in one right now that could have started, earlier this year, just in the beginning of January at that high, and we wouldn't really know it. I mean, as I speak, I think we're down about 7 or 8% or something on the S&P 500. Well, there's no way anyone can look at that and say, yes, this is a bear market. This is it. This is the end. You won't know it until you're in it. That's why I always say it's folly to try to predict it. You have to prepare for it. I always say that: prepare, don't predict.
Yeah, and I like how you say that, Dan. But so let me ask you, because you really go into detail of how the folks should be preparing for this catastrophe, really. Let me ask you the tie into inflation. Is part of your thesis, and correct me if I'm wrong, that the Fed will do everything possible to stop inflation? And is that what would lead to the correction in the stock market?
Well, my particular thinking about the Fed is not something that most people have ever heard before. Sure, the Fed, if they believe that inflation is serious, and they're sounding more and more that way all the time, they will very likely raise interest rates. And usually when the Fed raises interest rates, they don't just do it once. Whether they're on a tightening or a loosening trend, they always do it more than once. So yeah, there could be some interest rate raises in our future, and that could act as a catalyst that could then lead to a bear market, certainly. But when I look at the Fed, I look at a group of people who strongly believe that they're in control of things that I don't believe they're really in control of. And the market thinks they're in control of them. But we know that they oversaw two of the biggest declines in history, right? The dot-com bust and the great financial crisis. They couldn't foresee or prevent either one of those. And they get a lot of credit for fixing them after the fact, which I find very odd. But they couldn't see what everyone else could see happening around them. So, I don't believe so deeply in the Fed's power to control a multi-trillion-dollar economy and a multi-trillion-dollar stock market.
Really well said, Dan. And let me ask you this, to that point, when Powell had come out earlier this year saying, look, don't panic, folks, the inflation is transitory, and obviously we know the outcome of that.
Right.
Do you think at that moment, did he really believe, did the Fed really truly believe it was transitory, or were they just trying to calm things at the moment?
That's a good question. I don't know if the answer really matters, but it's a very good question. And they really didn't know, but they knew what they had to say. That, oh, okay, when something new develops that is potentially negative, like, oh, inflation creeping up to multi-year highs, they have to come in and say, don't worry, it's transitory. It'll all be over soon. I mean, remember 2 weeks to flatten the curve? I mean, that, as
Right.
soon as COVID popped up, right, everybody's, oh, don't worry, this will all be over soon. So
Ah,
that's
yep,
just a typical sort of, government or
right.
government, they say the Fed's not the government, but it sure looks like it to me. And it's a typical narrative type of a thing.
So, Dan, are you suggesting or do you believe in the end the Fed movement?
Sure I do. Yes. And the Fed. It's an insidious institution, that since the Fed, look, the Fed started actually in late 1914 is when the New York Fed opened for operation. Before that time, we had these events where we call them panics, and a few banks, maybe a couple of dozen banks would shut down. And then, we had the 1907 panic, and whoa, that started the conversation. Then we wound up with the Fed in 1913, the act being passed, and it opened in 1914. And then within several years, we get still the biggest financial calamity in the history of the country. Okay, well, what's the Fed worth to you now if you really realize that, they couldn't stop the biggest financial calamity? Some people would say they didn't stop it because, well, they just didn't use the tools right. Oh, okay. Well, what is it that we knew 100 years later, almost, during the financial crisis? Because whatever that knowledge was, it didn't seem to prevent the financial crisis, did it? So I have my doubts that the Fed is really should exist, or that any central bank anywhere in the world should exist.
So, Dan, before we get to assets you're liking right now, let me ask you this. On the topic of inflation, have we hit peak inflation?
Peak inflation? I don't know, but I sure think that we're going to see plenty more of it. And it's bad enough right now. If it just continues high single digits for several years, I think that's bad enough to cause some serious degradation in your equity portfolio, and you'd better be prepared for that.
So let's talk about assets you like, Dan. Where do you see safety right now? Is there
Well,
any place that's safe?
look, there's two basic things you have to worry about now, I think: inflation and potential for a bear market. They're generally things that you buy opposite types of assets to prepare for. Like, you want to hold cash if you think equities are going to fall, because then, first of all, your overall portfolio performs better. Second of all, you've got a treasury there that you can spend and put into lots of cheap stocks, dry powder, so they call it. And if you think inflation is a problem, that's a different problem. And you want to own the right stocks. You want to own things like gold and silver. I don't think gold is dead. I think all that talk is nonsense. I think Bitcoin might perform well if inflation keeps ticking higher, as I expect. Then you want to own businesses. There you can have an equity portfolio that does really well in inflation.
It's interesting you suggest to own both Bitcoin and gold.
Mhm.
Are you suggesting they both perform well in an inflationary environment? And if I could take it one step further, has Bitcoin been tested enough in this kind of environment?
No, it certainly has not. It's extremely, the history goes back to what, January 2009? So that's not much of a history, and we really don't know what to expect. But it has some good underlying fundamental characteristics, the inherent scarcity of it. Um, and it's outside the financial system, right? It's priced in dollars. It's not a dollar. So it's a potentially good store of value. It's a terrible currency because it doesn't have short-term stability. You want currency, that's the other side of it, right? That Bitcoin is a potentially good store of value that can protect you against inflation. Dollars are a medium of exchange and a currency that you want to own if there is a downturn, and especially if there's a bear market.
Do you have like percentages? I mean, obviously it depends on, the investor and whatnot, but is there a number you like in terms of how much gold one should own vis-a-vis Bitcoin, vis-a-vis cash?
Those things I'm not a big believer in, kind of pat off the shelf solutions for everybody.
Right.
But, when I say you should own plenty of cash, for example, I mean probably 20% or more relative to your equity portfolio. So, your equities are 80%, your cash is at least 20%. probably somewhere between 20 and 35 or 40 maybe. And then with gold and silver, I would have probably more gold than silver, and probably in the neighborhood of 10 to 15%. And then I would probably, Bitcoin is, you could do 1 or 2% Bitcoin, and the potential for the upside there is quite breathtaking under a number of scenarios. So, 1 or 2% could be plenty of Bitcoin.
No, and I hear what you're saying in terms of those cookie cutter solutions, because every time, how many times have we heard, well, you should have 5 to 6% of your portfolio in gold? I just cringe because, as you say, there's no,
Yeah.
there's various scenarios and whatnot. But
Yep.
taking it one step further there on the gold and silver front, do you like physical or the stocks, or a mix of both?
So when I say, 10 or 15% gold, I mean physical gold and physical silver. But I do think you should own some gold equities in your equity portfolio. Absolutely. What percentage that is, let's not even get into it. Just as long as they're in there, they ought to perform pretty well in the next 5 or 10 years.
Okay, switching it up now, Dan. I also want to talk emerging markets, which is a big focus of yours. And I know we've had offline conversations where you feel, this is an area that's not covered enough. Opportunities in emerging markets.
Yeah. So emerging markets and even ex-US developed markets. I like Japan too right now. But yeah, emerging markets like Chile and Brazil are two that kind of made it onto my radar screen recently, because they are, of course, commodity producing nations. So you don't even need to own like a Brazilian or Chilean commodity producers. You could own an ETF that just has, a bunch of other companies and maybe some financials in it, and you'll get the same benefit. So those two I like a lot.
Okay, really good tip there. I guess as we wrap, Dan, any final thoughts for our viewers as they're navigating these, unprecedented times here? It's scary times.
Yeah, it is unprecedented. I think we're at a major inflection point, and I'll reiterate what I've said for the last year or more. I think now more than ever, you need to be truly diversified. If you have equities, the only true diversifier is cash. So you should have plenty of that too. If you're afraid of inflation, gold and silver, a little bit of Bitcoin, and some really good equities. I have our 10 stock inflation protection portfolio for extreme value readers coming up. And as far as these other things, the emerging markets, and we didn't talk about growth value. That's another thing that's at an inflection point. Commodities versus stocks, all these big inflection points, you can get at them with a really good equity portfolio. And of course, I'm going to say, I think we do all of that stuff great in extreme value, right?
Absolutely. Absolutely. And Dan, that's a good point you brought up to wrap here on diversification. Do you think there's a misconception out there that a lot of folks think, well, wait, I'm diversified in my stock portfolio. That's diversification.
Right. If all you have are equities, you're not diversified. You need other assets to diversify against them.
All right. Well, Dan, I had a great time filming that interview with you. I invite everyone to check it out so they can learn your great pick. The website for that is inflationplan2022.com. Again, it's inflationplan2022.com. Dan Ferris, come back anytime. Always love chatting with you.
Thanks, Daniela. Me too. I always enjoy it.
Thank you. And thank you all for watching. We'll have much more for you on stansberryresearch.com. And don't forget to sign up for premier content you can't get anywhere else at danielacamboni.com. That's it for me. Thanks for watching.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.